This is your standard 401k plan, right? It's tax deferred. So when you put money in, you get a tax deduction. It grows tax deferred, and when you pull the money out, right, then that's when you pay the tax. This is the Roth IRA. That's tax-free. So you don't get the tax deduction going in, but when you pull the money out, it is tax-free. Well, where do I put it in? Do I put it in the Roth or do I put it in the pre-tax? Well, first you want to make sure that you understand what tax bracket that you're in, because we're in a marginal tax system here in the US and people get a little bit confused. So this is married, finally, jointly, okay? So let's say that a couple makes $100,000 a year gross. Right? So then you look here and it's like, well, $100,000 falls right there. So does that mean they're in the 22% tax bracket? The answer is no. Right? Gross income is one thing. Taxable income is something completely different. You take your gross and you minus your deductions, and then let's say 401k contributions. 100,000 gross, you put 20,000 into a 401k plan, another 20,000 deduction, so that's 40,000 bucks. So my taxable income in that case would be 60 grand. Your first roughly $20,000 of the 60 is going to be taxed at 10%, and then the remaining 40,000 will be taxed at 12. So you don't even touch the 22% tax bracket. So when you determine where you want to look at savings, you have to understand where your tax bracket is, okay? Because if I'm in these lower tax brackets, 10, 12, maybe even 22, it might make sense for me to go straight Roth because I'm not getting a huge savings here from a tax perspective. If I'm in these larger tax brackets, well, then I got a lot bigger bang for my buck. But what we find is that a lot of you have all of your money here and you're doing a good job of saving. Maybe you start maxing this thing out. Now you got $1 million in here or a couple million bucks. Well, just know that every dollar that comes out of here is going to be taxed at ordinary income rates. Tax rates are going to go up in the next few years, just how the law is stated today. So you want to look at making sure that you have the right balance of where you're saving your money so you don't kind of trap yourself into one pool here where potentially the tax savings that you got today, you're going to end up paying a lot more tax on the other side of the road. Okay? So tax diversification is key. That can help you stretch your dollars out even more.
Yeah, and I think what we find, as you said, Joe, is most people have the bulk of their savings in tax deferred. Then you add a pension and Social Security on top of that, which are taxed at ordinary income. Maybe you got a rental property taxed at ordinary income, which is the highest of tax rates. That's why we're very we really like the Roth IRA, the tax-free. So consider Roth contributions, 401k Roth contributions, Roth conversions, taking money from your IRA 401k, converting it to a Roth. Yes, you pay taxes currently. Tax rates are lower today than they have been and probably lower than they will be. So it's a great time to think about Roth accounts.
Yeah, without question. I think it's just really understanding what your goals are, what you're trying to accomplish, how much money that you're saving, what these ending balances are going to be, right? What other sources of income that you have, right? It's just start putting your plan together, put it on paper. If you need help to understand what IRAs are available for you, just go to our website, yourmoneyyourwealth.com. We got 8 different IRAs. It's awesome. It's a really good read.